All right. So basically, if we talk about business valuation, we are just trying to look at the value that the company can place on its shares when they want to sell the business, or the value that the company can place on the company if they want to give the company to another person. Or if there's a takeover, you see that new management is coming. So what value are we going to place on the company? What is the value of the company that we are taking? That is basically the business valuation. So business valuation, if you want to sell business, if you want to sell the business, mostly the unlisted businesses, the unlisted companies, companies that are not listed on the stock exchange market, it will be very difficult for us to determine the value of their shares. So what we do is that at the day that we want to sell the business, we need to find the value of the company. We need to find the value of the company. We need to know the amount at which we are going to sell the company. So if you talk about business valuation, we are just talking about placing value on the ordinary shares, or we are looking at the value of the owners. What is the value of the owners in the company? Why should we value a business? Why should we value a business? We can value business if the company want to sell, like they want to dispose of the business. If they want to dispose of the business, we need values that we have to place on the business that we are going to sell. So we can value business when there is a sale, when the company receives a bill to sell the company. We can also value the company or the business when the business want to go public. Going public means that they want to get listed on the stock exchange market. They want to get listed on the stock exchange market. They want to get listed on the stock exchange market. It means that we have to know the value of the business that we are going to put on the stock exchange market. Another one also is in issue of liquidation. In situations of liquidation, the business want to liquidate it. They want to stop operating and come back later, or they want to dispose the business. In that case, what they will do is that what is the value of our business? What is our value of our business? The company is making a losses and they want to come back. They want to restructure. They want to turn around. What they have to do. So if you are turning around, it means that if you are making losses, we are going to make the business look like the business is being born again. We are starting afresh. So if we are starting afresh, what is the value of our assets? What is the value of our shares and those kind of things? We also value business in the case of liquidation situations. When one of the shareholders want to sell their shares, we have to know the value that they are going to sell the shares for. So we have to value the business. Sometimes we can also value business as a form of collateral security to take loan. So we can tell the bank that, okay, this is the value of our company. So you can give us the loan. If we are not able to pay, you can take some of the shares or some of the asset back. That is also a reason for us valuing a business. But the two of the reasons, or most of the reasons is the business want to go public. That is why they want to get listed. If they want to sell, or if there's a takeover, the company taking over has to know the value of the company that they are taking over. How do we find these values? How do we find these values? You have to know that the value that we are talking about the value of the owners. So we are talking about the value of the equity shareholders. What is the value of the equity shareholders? You can see that if you talk about equity shareholders, they have their share capital, they have retained earnings, they have other components of equity. We are talking about all these things put together. What is the value that we can place on it? So if you're talking about business valuation, we are talking about valuing the value, or placing value on the portion of the business that belongs to the ordinary shareholders. The ordinary shareholders. So we are looking at what is the value of the ordinary shareholders in the company. That's what we are talking about. So basically, we are looking at the value of the ordinary shareholders. Not preference shareholders are not parts, creditors are not parts. The portion of the business that is owned by the owners. That's why we are talking about business valuation. So basically, if you are doing business valuation, we are only talking about the portion that is relating to the ordinary shareholders. How can we find these values? What are the methods? What are the models that we use to find these values? We use the first one we call the net asset method. The net asset method, what we do is that, okay, we look at the asset of the company, then we look at the liabilities. If you subtract total liabilities from assets, what are you getting? It's not the equity. It's not equity that we are going to get at the end. So the net assets that we do is that we look at the value of the asset at the date of the valuation. Then we subtract our total liabilities from it. Then we get our our fair values. So under net asset method, what we do is that it is net asset valuation method provides a lower limit for the value of a company. By itself, it is unlikely to produce the most realistic value. In this model, value of a share is equal to total asset minus total liabilities divided by number of shares. If you are doing it by per share, at the end of the day, the answer that we get, we divide it by the number of shares. They are talking about the ordinary shareholders. So that's net asset per share. Intangible assets are excluded as they do not represent the worth of the company physical assets. But if they have market value or lances which could be sold, then they can be included. So if you are looking at the total asset to subtract the total liabilities, what we do is that we don't include intangible assets like goodwill unless they have a market value, they can be sold. So if you have a lances that can be sold, then we include the lances in the calculation of the net asset. But if it cannot be sold, we assume that it is worthless. So the value will not be included when we are doing the calculation. We have so many ways of calculating the net asset using the net asset table. We can use book value, which is a carrying value. So sometimes they will not give you the market value of the asset when you are doing the valuation. So you use the carrying value. Or sometimes a company which is taking over would like to continue using the asset. In that case, we can use the carrying value because since they are going to continue using the asset, it means that it's the same value that the asset will be given to them. So we can use the carrying value. But sometimes we can also use the market value when you are selling, or the fair value when you are going to sell the business. Then you have to value the asset to their market value, their current market value. So in the case of sell, we use the market value. In the case of sell, we use the market value. In the case that you are going to list, you are going to get a company listed on the stock exchange market, we use the market value. Or mostly, we use the market value in determination of the net assets. So under the net asset method, what we do is that is the total assets minus total liabilities. What about the next one? Let's look at all the methods one by one before we move on to calculations. All right. The next one is the income-based valuation models. Under the income-based valuation models, we have what we call price-earning ratio. We have what we call price-earning ratio. I hope we all know how to calculate price-earning ratio. Under the income base, we have what we call price earning ratio. All right. Let me share this with you. Habakkuk, can you calculate? Do you know how to calculate price earning ratio? Habakkuk, are you there? Price earning ratio. Price earning ratio. Habakkuk, are you there? Jocelyn, are you doing FR? Habakkuk. Habakkuk, are you there?
Elanos.
Yeah. I'm talking about price earning ratio. Do you know how to calculate price earning ratio?
Hello.
Yeah, can you hear me?
Yes.
Price
I
earning
was
ratio.
doing something small.
Okay, price earning ratio. Do you know how to calculate price earning ratio?
Yes, please.
It's calculated as what?
Share price over EPS.
Share price over what?
Earnings per share.
Okay. In this case, we are saying that we are using the price earning ratio to calculate our market value. So it means that what we are going to look for this formula is the market value. So if we are looking for the market value, it means that our market value per share will be equal to price earning ratio times our earnings per share, isn't it? All right. So if you are looking for the market value of the company using the price earning ratio, the market value is calculated as price earning ratio times the earnings per share of the company. But the price earning ratio that we use is that of a similar company or a company which is listed. A similar company which is listed. So the price earning ratio you use is for a similar company which is listed. Since the company is not listed, we cannot have their price, the market shares, the price of their market, the price of their shares. Since the company is not listed, we can't find the value of their shares. So the price earning ratio that we use is for a company which is listed, for a similar entity which is listed. Okay, but what we do is that after calculating our market value using the price earning ratio of a similar company which is listed, we normally adjust it by within the margin of 70 to 85%. So since the company is not listed, you cannot be using the same market value to value it. So after getting your market value, then you adjust it by 70 to 85%. So you multiply your final answer by 70 to 85%, any of them. This is market value per share. This is how we find the market value per share using the price earning ratio. If you want to find the total value of the company, then using the price earning ratio, what we do is that our value of the company using price earning ratio is equal to price earning ratio times profit attributable to ordinary shareholders. You can see that the way we calculate earnings per share is the same as the profit attributable to ordinary shareholders over ordinary shares. That is how we do it. So you can see that if you are finding the total value of the company, we don't use earnings per share, but we rather use a profit for the year. All right. The next method is dividend yield. How do you calculate dividend yield? Abakuk, how do you calculate dividend yield? Oh, you're not there. Dividend yield is calculated as earnings per share over market price. So if you are finding the market price, what we do is that the market price is equal to...
Yeah, come again, us.
Yeah, I'm talking about dividend yield. How do you calculate dividend yield? Is the dividend per share divided by market price.
Hello.
I'm saying that can you hear me?
Yes, now.
I'm saying, how do we calculate dividend yield?
Dividend yield.
Yeah.
Yeah, I forgot to know. Sorry.
Dividends per share over market price.
Okay, so in this case, we are looking for the market price. So we make the market price a subject, isn't it?
Mm-hmm.
If you are making the market price a subject, it will be dividend per share over dividend what? Yield.
Dividend per share.
Over dividend yield, isn't it?
Yeah.
Okay. But what we use over here, the dividend yield that we use is the same as the dividend yield of a company that is what? Listed, a similar company that is listed. We assume that the company that we are valuing is not what? Listed. So what we do is that we look for the the dividend yield of a company or a similar company that is already listed on the stock exchange market. So the dividend yield that we use in the question is dividend yield for a similar company, which is listed. Okay. But you can agree with me that a company that is not listed and a company that is listed, the shareholders of a company that is not listed, they will be demanding more returns than a company that is listed, isn't it?
Yes.
So what we normally do is that the dividend yield that will be given to you in the question, we normally adjust it by 20 to 20% to maybe 40%, depending on the nature of the company that you are valuing. So if the dividend yield given to us for the similar company is 10%, we increase this by 20 to 40%. So you can increase this by 1.2 times 10%, which will be 12%. So it will be the 12% that you use to value the company that they are asking you to value. It will be that 10% that you are going to use to value the company that you are going to value. Another method is earnings yield. Another method that we use is earnings yield. Another method is earnings yield. How do we calculate earnings yield? Earnings yield is calculated as what?
Yeah, profit of that over market share. Hey, my I forgot to.
Earnings per share is the same as the dividend yield, but just that we replace the dividend per share by earnings per share.
Any per share over market price.
Exactly. So earnings per share over market price. But in this case, what we are looking for is the market price, isn't it? So for us to find our market value is equal to the earnings per share divided by earnings what? Yield. But the earnings yield that we use over here too is for a similar company that is listed. So we also adjust that one by 20 to 40%. But sometimes they can give you growth in the earnings. If there is a growth in the earnings, it is calculated as market value is equal to earnings per share into brackets 1 plus G. The G is the growth rate. Okay. Then all divided by the earnings yield minus the growth rate, the G. So if they are giving you growth in the earnings, that is how we do it. All right. We can also calculate value of a share using how we calculate the cost of capital. We can also use the dividend valuation model. We can also use the dividend valuation model. Dividend valuation models. We can also use the dividend valuation models. If you're using the dividend valuation models, we have the first one, which is constant dividends, So if the dividend is constant, how do we calculate our cost of capital? If the dividend is constant, how do we calculate our cost of capital? The cost of equity is calculated as what? KE is equal to what? Hi. When we are paying constant dividend, how do we calculate the cost of equity? KE is equal to what?
The dividend over price.
The dividend market
the
price, isn't it?
PO.
Okay. Dividend over PO, isn't it?
Yes.
All right. But what we are looking over
PO.
here, what we are looking for over here is the market price. We are looking for the market price. So if you want to find the market price, which is the PO, how are we going to do it? We are going to make the PO the subject. Making the PO the subject, this will be equal to DO divided by what? Cost of what? Equity. So we can also use the cost. The question can give you issues about constant dividend, that when a constant dividend where you are going to use the cost of equity method to find the value. The value that we are saying that you are looking for is the market value. So you can find the PO by interchanging your cost of capital is equal to dividend over market price. What if we are paying, the dividend is growing at a constant rate? Growth at a constant rate. What do we do? When the growth is at a constant rate, KE is equal to what?
Is it
DO.
Okay, DO. DO. Okay, the person can now DO is equal to what? 1 plus what?
G?
1 plus G. 1 plus G. All divided
Yes.
by
All
PO.
divided by PO plus
Okay. Then
plus
all of these answer plus what?
G.
G. But in this case, what we are looking for over here is the PO. So you have to make the PO the subject. Making the PO the subject, this is what we are going to have. We are going to have
Okay.
into brackets,
DO
into brackets,
1
1,
plus G
1 plus G, 1 plus G, all divided by,
by KO
all
minus
divided by EE minus G.
G.
Okay. If you are looking at growth at a constant rate, if you are going to look at the value of debt, if it is redeemable debt, what do we do? If it is redeemable debt, how do we calculate the cost of debt? So it's the same thing that you are going to use, but just that you are going to make the market value the subject. You are going to make the market value the subject. So if it is irredeemable debt, you look at the two formulas. If there is no tax, cost of debt is equal to the interest over the market what? Price, isn't it? All right. In this case, if you are looking for the market price, what do we do? The market price will now be the P, which is a PO, is equal to the interest divided by the cost of the debt. That is how we do it. If there is no tax element, if there is a tax element, then your PO will now be equal to the after tax, which is the I into brackets 1 minus T, all divided by the cost of debt. That is the market value of debts. If you are using irredeemable debts, what we do is that we just pick the formula, then we make the market value the subject. That is all. So they will give you the cost of the debt, they will give you the interest, then you just put it in there and find the market value. That's what we do. Let's come to redeemable debts. If it is redeemable debts, if it is a redeemable debt, what they will do is that they will give you the cost of capital for the redeemable debt. So what you do is you just present value the interest payments, and you also present value the redemption. So if you put the two together, it is the redemption amount. If you put the two together, the sum of this present value is the value of the irredeemable debt. So basically in the exam, they are going to give you maybe 3 methods, which will be, you cannot go to the exam without seeing question on net assets. You cannot go to the exam without seeing question on how to use a price earning ratio. And you can also not go there where you will not see question on dividend yield or earnings yield. For this redeemable debt and cost of capital, before you see them, it's very hard. But if the question is on business valuation, you either see price earning ratio, which are the common ones, the net asset method, the dividend yield, and sometimes they will give you what we call cash flow. We also have what we call the cash flow method. For the cash flow method, what we do is that they will give you the cash flow for the subsequent years, that the cash flow that business is going to generate in the subsequent years. So what we do is just we discount it. We have the years here, then we have the cash flows here, then we have the cash flow, then you have your discount factor. They will give you the cost of capital of the company. Then we find the present value. So you pick the year one, what is the cash flow in the next 1 year? Then you put it here. What is the discount factor? How do we calculate the discount factor? It is 1 over 1 plus R or exponent n. The n is the cost of capital of the company. So we just present value this and total it. That is the value of the company. If they are asking you to do it per share, then we divide the present value by the number of the ordinary shares. That is all. Let's pick a question. This is all about the business valuation. Let's pick about 3 questions. Then we are done with business valuation. It is very simple. And it is very simple because you have done cost of capital already. All right. Let's pick a question. Then we see tutorial question 1. Who is reading? Fast. Let's move on. Who is reading? Tutorial question 1.
The directors of pork. Hello.
Yeah, I can hear you.
The directors of pork, a pack
Name
company
it
are
anyhow.
considering.
It's a noun.
The directors of pack company are considering making an offer to buy 100% of shares in Right Company, a competitor company.
Okay.
Extras from the most recent financial statement of Right Company as follows. Statement of profit or loss for the year ended 31st December 2005. So profit before tax, we have 2,200
Okay.
with 3 zeros up. So, and then tax at 30%, we have 600, 660.
Okay.
Profit after tax, we have 1,540.
Okay.
And then dividends declared, we have 250.
Okay.
Statement of financial position at 31st December 2005. We have freehold land and building, 8,500. Plant and machinery, we have 5,800. Current assets, we have 4,300. Share capital into bracket 50 Ghana pesos ordinary shares, we have 500.
Okay.
Retained earnings, 7,900. 6% irredeemable preference shares, we have 8,000.
Okay.
Current liabilities, we have 2,200. Additional information. A recent independent valuation of some of the company's assets showed that the land and buildings were worth 9.6 million and plant and machinery 3.2 million.
Okay.
The current assets balance sheet balance include a receivable of 0.2 million from a company in liquidation and some inventory worth 0.4 million less than its current value.
Okay.
C. Some research into listed companies in the publishing industry shows the following. Average price earning ratio, that's 11.
Yeah.
And then average dividend yield 3%. D. Adjustment I above will necessitate a revision of the 2020 draft profit before tax. The dividend payment will, however, not be affected.
Okay.
Required. Determine the value to be placed on each share of Right Company Limited using the following methods of valuation.
Okay.
A. Net asset. B. Price earning ratio. C. Dividend yield. D. If the return required by debt holders of right is 7.5%, calculate the market value of irredeemable debt. Show your answer by to the nearest city.
Okay. Okay. So this one there, it should be adjustment in B. It should be adjustment in B. The adjustment in B is going to necessitate the revision of the 2020 draft profits. All right. You see, whenever you pick a question, no matter what you are going to do, if you are going to do your net assets, if you are going to use net asset table, you automatically adjust some of the asset values. It is automatic because the current value that you have in the statement of financial position at the day that you want to sell the company, the value might not be the same, isn't it? They might increase. So we use the new values at the day that you want to value the business. We use the new value of the assets now. We use the new value, or we use the actual value of the asset at the date that you want to do the valuation. Another one is that you are going to adjust the profit for the year. They will give you footnote, or they give you additional information that will make you to adjust the net profit for the year, or the profit for the year. You know that the profit for the year will be used in calculating, it will be used in the price earning ratio, So you automatically adjust your profits. For the dividend yield, sometimes the dividend given to you can include that of the preference shares and also the ordinary shares. The dividend that we use is the one that is for the ordinary shareholders. So if the dividends that are given to you includes both ordinary and preference shares, then you take the preference shares, their parts off. So what you are going to do over here is that calculate 6% on the preference shares. Let's see something. Let's see their dividends. 6% on the preference shares. Calculate that. Let's see something before we move on. What are you getting? 480. What is the dividend declared? 250. So this can tell you that their dividend is not part of this one. This dividend is solely relating to what? Ordinary shareholders. So if you have the dividend to be 700, then you assume that the 480 is part. Then you take the 480, then you know the dividend relating to the ordinary shareholders. If you are doing your dividend yield, we use the dividend relating to the ordinary shareholders. We use the dividend relating to the ordinary shareholders. Let's solve this question. People, let's solve this question. The first method is what? Net asset method, isn't it? Okay.
Yes.
Net assets. We say the net asset method is what? Total asset minus what?
Total liability.
Total liabilities. Okay. So they are keeping 3 zeros at the top, isn't it?
Yes.
Okay. So let's go and look at our asset one by one. Let's look at our asset one by one. Okay. Okay. Let's look at our asset. I hope you can see the asset figures. Okay.
Yes.
Okay. Freehold land and building. That is the first asset. So let's just put land and building there. Okay. So land and building, what is the value in the statement of financial position?
8,500.
But additional information, what are they saying about the land and building?
You can't use it unless you adjust it.
The land and building is now what?
9.6 million.
Which is 9,600, isn't it?
Yes.
So this is the value of the land and building, the time that we want to sell. So if they are saying that, okay, the land and building was 8,500 before, now it is 9,600, how much are you going to sell it?
9,600.
So we use the 9,600 as the new value of the what? The land. Are we okay?
So the new value, is it the fair value, right?
Is a fair value, the market value.
Okay.
So the market value now, any value that will be given to you in respect of land and building or in respect of assets in the statement of financial position now becomes the new what? Value. Sometimes they can say, okay, the building has increased by maybe 1,100. So what you are going to do is that if you have 8,500, it means that this value has increased by 1,100. So you go and add the increased value to it, and that will now become the value that you are going to sell the asset.
Okay.
Okay. In this case, they can also give you that the new value of the land and building now is 8 million. It means that the land and building can now be sold at 8 million. So the 8 million now becomes the market value of the land and building. Are you okay? Okay. Let's look at plant and equipment. But if they don't say anything about them, it means that the carrying value is the same as the market value. So we just use the carrying value. Okay. Plant and equipment. What is the value of the plant and equipment? It was 5,800. But what are they saying right now?
They said it's now 3,200.
So if you want to sell it, are you selling it at 5,800 or you are selling it at 3,200?
3,200.
So the 3,200 is now the new value. Let's look at the current assets. Okay. The current asset, what are they saying about the current assets? What is the value that we have over there? 4,300, isn't it? All right. They are saying that the current asset balance includes a receivable of 0.2 million, which is 200, isn't it? From a company in a liquidation. Are you going to receive that 200 from them again?
Maybe.
No.
No,
Are you going to receive it?
we are not. They are in liquidation. I don't think they will have money to pay.
No. So what will happen is that 200, which is included in the current asset, you cannot take it. So you have to go and take it from the current asset. Are you okay? So let me put the current asset over here before we adjust. So we are going to have 4,300, isn't it? But the 200 that the people are owing us, we can't take it. So it means that it will be gone. What else?
4,900.
So what else? And some inventory worth 0.4 million less than it carrying what? Value. Some inventory worth what? 0. What?
4.
0.4 million, which is 400 Ghana cedis, is less than its carrying value. It means that is the inventory value increasing or it is reducing?
It is reducing.
It is reducing. So what are we going to do? It means that if the inventory value,
It's a loss.
if the inventory value is 2,000, which is included, inventory is included in current asset, isn't it? So if the
Yes.
value is 2,000 and that it is included in the current asset, they are not telling us that the value is 1,000 what? 600. Are we okay?
The value is 1,006.
It's 1,600 now, isn't it? So, but in the current asset is 4,300. So what do we go? What are we going to do there? In the current asset, it was 2,000, but now they are saying that it's 1,600. So we go and reduce the 2,000 over there to what? 1,006. So what you do is that you go and subtract the 400 from your current asset. So to make it now to the new value, so you subtract the 400. What will be the effect of the 0.2 million and the 4.2 million on the profit? Is it going to affect our profits?
Yes.
Okay. You can see that the 0.2 million is not a bad debt, isn't it?
Yes.
Okay. So what is the effect of bad debt on profit? It's going to reduce the profit, isn't it?
Yes.
All right. If there is obsolete inventory, it means that our inventory value is reducing. The reduction is an expense to us. That means we are losing, isn't it?
Yes.
If we are losing, what are we going to do to profit? We are going to subtract this also from what? Profits.
Yeah.
So the 0.2 million, which is a bad debt, will reduce the profit because they did not take this into consideration before preparing the statement of financial policy. That is why it is additional information. All right. So what is the value of our current assets now?
3,700.
3,700. If you put all together, what will be the total value of the assets?
Mm.
Okay. So what are we going to do? We subtract our liabilities. So let's subtract our liabilities. If nothing is said about the liabilities figure, we assume that all their value over there are the same as the value at the date that we are going to sell the business. So what will happen? What is the first liability there? Current liabilities. Okay. Let's take the current liabilities first. They didn't say anything about the current liabilities. So we assume that it's the same amount that we are going to pay them, 2,200. What is the next one?
Is it the preference shares?
I mean, the preference shareholders are not owners. If you are doing business valuation, we are looking for the value of the company for the owners portion of the company. That is what we are looking for. So preference shares, debentures, are all those things are not owners. So you take all of them. So the preference shares will also go. Sometimes they can give you a footnote on the new value of the preference shares. They can now say that, okay, the preference shares holders will now be having 9 million. In that case, the 9 million now becomes the value that you are going to pay to them. So the 9 million becomes the new value. But in this case, since nothing was said about them, it means that the 8,000 is the same 8,000 that we are going to pay to them. Are we okay? All right. So what will be the value of the company now? We subtract our total liabilities from our total assets. And I'm having 6,300. Am I correct? So this is the value of shares, of value attributable to the ordinary shareholders. What is the question saying? The question says that determine the value to be placed on each share of RightCo using the following methods of valuation. So this 6,300 over here is relating to the total value of the shares. Are you okay? All right. This is the total value of the shares. This is the total value of the company. But how many shareholders are there and how much one person received? That is what they are saying, that per share. This is for the total number of ordinary shares in the company. How many shares are there and how much will one person receive? Let's go to the number of shares that are there. What is the value of the shares? What is the total value of the shares? What is in the statement of financial position? What is the total value of the shares?
500 cedis,
But these shares were issued at what?
50 pesos.
So how many shares were issued?
Is it 10?
How many shares were issued? How many
10.
shares that if you multiply by 50 pesos will give you 500 Ghana cedis?
1,000.
That would be 1,000. It is the value of the shares divided by the value per share. So number of shares will give us the 500 divided by the 0.5. So if you issue 1,000 shares at 50 pesos, the money that you are going to take from it will be what? 500 Ghana cedis. So we divide this by what? 1,000. What are you getting? I'm getting 6.3. Am I correct? So value per share. But if the question say find the value of the company, we don't divide. So if you say find the value of the company, then at 6,300 is now the value. But they say value per share, the 6,300 is for all the total ordinary shareholders in the company. So how much one person receive? That is the value to be placed on each share. So you divide the value by the number of shares in issue, and that will give you 6.3. The next method is what? The next method is what? Price earning what? Ratio. We use a price earning ratio. Price earning ratio. Another price earning ratio. Another price earning ratio. Market value is calculated as the market value per share is calculated as the price earning ratio of a similar company times the earnings per share. If you want to find the value per share. All right. But earnings per share, how do we calculate earnings per share now? How is earnings per share calculated?
Market.
Earnings per share. Profit
Market.
attributable to earnings per share is calculated as what? Profit attributable to what? Ordinary shareholders. Ordinary shares divided by the number of ordinary shares. That is how we calculate the earnings per share. So earnings per share is the profit that you are taking to the ordinary shareholders. How much is one person receiving? That is the earnings per share. All right. Over the number of all divided by the ordinary shares. Divided by the ordinary shares. Okay. So the profit attributable. What you are going to do always is that you look for the profit attributable to the ordinary shares. So if you have ordinary dividends, you take it from the profit for the year. You take it from the profit for the year. So what is the profit for the year now? Okay, should I adjust it in the earnings per share or I should adjust the profit differently before I'll bring it over here? Okay, let me adjust it differently. Okay, so adjustment of profits. Adjustment of profit for the year. So we start with the profit after tax. What is the profit after tax figure in the question?
1,540.
1,000.
540.
Okay. But we now come to the additional information. Do you have anything over here that is going to affect our profits? Do you have anything over here that is an expense that was not subtracted for the profits? The current asset balance include a receivable of 0.2 from a customer who is what? Or from a company who is in liquidation, isn't it? So if the 0.2 million, which is 200, you're not going to receive it. So that is a bad debt. Are we okay?
Yes.
What is the impact of bad debt on our profits? Is it going to increase or reduce?
Reduce.
Reduce. So we take the the bad debt, because this was not considered before we are calculating or we are preparing our statement of profit or loss. Let's come to this one. Some inventory worth 0.4 million less than its carrying value. So now our inventory is reducing. Are we losing or we are gaining?
We are losing.
We are losing. So we have obsolete inventory. You can name it obsolete inventory or if loss on inventory. And that will be, since we are losing, this is going to reduce our what? Profit. So we subtract. So what will be the actual profit now? It will be the first one plus this plus this. I'm getting 940. Am I correct?
Yes.
So this will now be the actual profit attributable to the ordinary shareholders. And this is the profit that we are going to use to calculate the earnings per share. So our earnings per share now will be 940 divided by the number of shares. What is the number of shares that we have gotten?
1,000.
Okay. So what will be the earnings per share?
9.4. 0.94.
Okay. 0.94. So 0.94. So right now our market value can now be calculated as price earning ratio. What is the price earning ratio given to us for a listed company?
11.
11. So we use the price earning ratio of a listed company because the company that we are valuing is not listed. So they don't have market value. They can't calculate their price earning ratio. So if the company that you are valuing, the company is not listed. So any investment ratio that requires market value, the company cannot calculate it. They cannot calculate earnings yield because we need market value per share to calculate the earnings yield. They can't calculate the dividend yield because we need the market value. Since they are not listed, they don't have market value. So that will give us 11 times the earnings per share. What is the earnings per share? 0.94.
94.
Okay. What will be our market value now?
10.34.
10.34. But if you leave this answer like this, it means that you are assuming that the company is listed. But the price earning ratio that you are using is for a listed company. So they can't have the same value. So what we do is that we normally adjust this particular final answer by 70 to 85%. So let's adjust this by 70%. Let's reduce it to 70%. So you multiply your answer by 0.7. What are you getting? I'm getting 7.24. Am I correct? Am I correct?
Yes.
Okay. Another way of
Yes.
calculating
It-
the market value is this one. You have your market value. Then what you do is that you have your price earning ratio. Then you multiply it by the profits, the adjusted profits now. So what is the adjusted profit? This will be 11 times what? 11 times 940. Am I correct?
Yeah.
Okay, what will be the answer?
10,340.
Okay. 10, 3, 4, 0. But this is for the total company, isn't it? So the
Yes.
value that you have gotten over here is for the total number of ordinary shares. This is on total basis. But we are looking at the value that one person received. So how many ordinary shares are there? It's 1,000. So we divide this by 1,000. What are you getting?
10.34.
So this 10.34, then you now adjust it by what? 70%. You get the same answer. All right. Let's look at the next method. The next method is what? Dividend what? Yield. So the dividend yield, we are looking at the market value and the dividend yield. How is dividend yield calculated?
Dividends per share over market.
Dividends per share over what?
Market.
over the market price, isn't it? So since now we are looking for the market value, it is now be equal to the dividend per share divided by what? Dividend what? Yield. Are we okay? All right. But I'm saying that since the dividend yield is for a listed company, unlisted company, they are going to be expecting more returns than a company that is what? Listed. Because a company that is not listed is very risky. The company can collapse at any time and you'll not be able to sell your shares. You'll not be able to trade your shares. So the company that is not listed will be demanding more returns than a company that is listed. So what we normally do is that the dividend yield, we normally adjust it by 20%. So if you're adjusting it by 20%, it means that you are going to increase it by 20%. So you can increase the 3% by 20%. Then that will now be the dividends that you are going to, the dividend yield that you are going to use. Do you have the dividend per share in the question? No. So we have to calculate our own dividend per share. What was the dividend paid to the ordinary shareholders? What was the dividend declared?
That average dividend yield is 3%.
That is the dividend yield.
And the declared is 250.
Yeah, we are looking for a dividend per share. The dividend yield is that of the similar company that we are going to use. So we don't do any calculation for that. But the dividend per share, you are going to use the dividend per share of the company that you are valuing. So what will be the dividend per share? It will be the dividend declared or paid to the ordinary shareholder divided by the number of ordinary shareholders. So this will be 250 divided by what?
1,000.
1,000. What will be the dividend per share?
0.25.
0.25. Okay. So let's now come to our market value now. Our dividend per share will now be 0.25 divided by 3%. But what we do is that we increase the 3% by 20%. This will now be 1.2 times 1.2 times what? 0.03. 3% will be changed to decimals. All right. Are we okay there? Okay. Let's move on. Market value is equal to
Sir,
yeah.
Solana,
Yeah.
are you trying to say with every dividend yield, we have to adjust it by 20%?
That's if the company that you are using the dividend yield to value is not listed, then you adjust it
If
by
it is
20
not
to
listed.
40%. Yeah.
Okay.
Are you okay?
Yes, sir.
Okay. So
Thank you.
if you adjust that, what are you getting?
But I thought they were listed. That's why they give us the market price.
No, they didn't give you any market price in the question. No.
The
Are you
11.
talking about 50%, the 50%?
No, the 11.
The 11 is the price earning ratio. Some research into listed companies in the publishing industry shows some listed. It means that this company is not listed, the one that we are valuing. If you read the top, they can also say they are not listed. Okay. So we use that one for so the company that we are valuing is not listed. That is why they are giving you that the research, some research into listed company in the publishing industry shows the following.
Okay.
So we assume that the company that we are valuing is not listed. Are you okay? The 50% was the value that the registrar general attached to their shares. So at the time that you are going to register the company, they will ask you to put some value on the shares. So they will attach that particular value. All right. And that is not the value of the shares. That is the value of the shares at the time that you are registering the company. But if you go to the stock exchange today, the value will be different. So we look at the value on the stock exchange market. So what are we getting? I'm getting 0.25 divided by 0.25 divided by 0.036. Is someone also getting the same thing? 0.25 divided by 0.036. Is someone also getting the same thing? Okay. What are we getting?
I don't. I don't have a calculator with me.
I'm
Anybody with
getting
a calculator can do it.
6.94 per share. Another way of calculating this is this one. You will decide to use the total dividends. So your market value will be equal to total dividend, which is 250, divided by the 1.2 adjusted with
So the 1.2, where did we get it?
the 1.2 is I'm increasing the distance.
Okay, the 20%
Yeah.
by the 20%.
Yeah.
Okay.
So if you are doing it like this, this will now be market value over 250 divided by 0.00036. Okay. 250 divided by 0.036. Okay, I'm getting market value is equal to 6944.44. But this is for the total one. So I will just divide it by number of the ordinary shares that I have. So sometimes you can decide to use the total, the answer that you have gotten, then you divide the answer by the number of shares that you have. You can also decide to use earnings per share and dividend per share. Then you will not divide again because you have divided the dividend with the number of shares before getting the dividend per share. So you are doing this for each share. But if you don't want to find the earnings per share or the dividend per share, then use the total profit attributable to the ordinary shareholders to find your market value. Then at the end of the day, you divide the total value by the number of shares in issue. You can also do the same thing for the dividend by using the total dividends. At the end of the day, the answer that you get, you divide it by the number of shares in issue. All right. Let's look at the next part. They are saying that if the required rate of return for irredeemable debts, that is the D, what calculate the value of the irredeemable debts? What is the irredeemable debt in the question there? What are they referring to as irredeemable debts?
Sure.
What are they referring to as the irredeemable debt in the question there?
Preference shares.
The preference shares. What do we do? Irredeemable debts are issued at what?
6%.
They are issued at 6%, but they are issued at what is the value attached to them? Per unit.
8,000. 8,000.
What is the value attached to them? Debts are issued in what unit? What is the value per unit?
100.
It's 100. So you can either calculate the value per share or you calculate the total value. But what is the question saying? What is the question saying? The question is saying that calculate the market value of the irredeemable what? Debt. So they are looking at the total value. So what you do is that you are not going to calculate it on the 100. You're not going to calculate the interest on 100. But you are going to calculate the interest on the total value, which is the 8,000. But if the question should say that calculate the market value per the irredeemable debts, it means that one debt, how much are they going to value it? Then on that place, we are going to calculate the interest on the 100 cedis. But this one, they are just talking about the value, the market value. So we assume that it is the total what? Total value that they are talking about. So irredeemable debts. So what we do is that how do you calculate cost of what? Cost of capital for irredeemable debt. It is the interest when there is no tax. Do you have tax in the question? Yes, we have tax in the question. We have tax in the question. The tax is 30%. So we assume that we are going to calculate after tax cost of capital. And this will be 1 minus what? T, all divided by the market price times 100. Or divided by the market price times 100. Are you okay? Okay.
Yes.
Market value. Okay. So what is our cost of debt? The cost of debt is the required rate of return that they are talking about. What is the cost of debt there?
7.5.
So we make it 0.075. It's equal to the interest will be 0.06, which is the 6% on what? On 8,000. Am I correct?
Okay.
Am I correct?
Yeah.
We are calculating this one on total value. So we apply the interest on the total market value given to us, which is the 8,000. Then we adjust this by the tax effect. So what will be the tax?
Yeah.
What will be the after tax? 0.7. Am I correct?
Yes.
Okay. All divided by the market value. So let's do this and see something. What are we getting? 0.075 is equal to 0.06 times 8,000 times 0.7. I'm getting 336. If someone also having calculator there, the person should confirm so that we move on. 336 divided by the market value. So if you are looking for the market value will now be equal to 336 divided by 0.075. 0.075. So I'm getting the market value to be 4480. So 4480. We are keeping 30. So this is the value of the irredeemable debt. Very simple. All right. So that is the first question. Let's try to solve additional 2 questions. Then let's try to solve additional 2 questions. Then we move on. Are you people trying the tutorial questions? Okay, the question 2 is very simple. Let's forget about the question 2. Okay, let's look at some of the okay. Okay, let's look at the question 14. Okay, question 14 is an ICA past question. Let's look at the question 14. Who is reading?
Pan Pana Limited is in advanced negotiation with shareholders of Zanu Limited to acquire 70% shares in that company. The following financial information is provided for Zanu Limited. Number of ordinary shares is 20 million. Net asset per share is 8 cedis. Earnings per share is 15 cedis. Price earning ratio is 10. The finance director who performed the due diligence review recommended the following. 1. Fixed assets included in the net assets were overstated by 6 million. 2. A key customer who owes 4 million has gone bankrupt and debts considered irrecoverable. 3. A provision of 10 million is made for a tax liability. 4. Panpana Limited cost of capital is 16%. A risk premium of 4% is added in the valuation of Zanu Limited to take care of additional operational risks. 5. The finance manager provided a statement showing projected cash inflows for the next 5 years as follows. So year 1 we have 125 million, year 2 we have 60 million, year 3 we have 150 million, year 4 we have 200 million, year 5 we have 110 million. So please
Okay.
can you move on? Required. Advise shareholders of Panpana Limited on how much to pay 70% of the shares of Zanu Limited using the following valuation method. A. Price earning ratio. B. Balance sheet valuation basis. And C. Cash flow valuation.
So the balance sheet valuation, what are they talking about? What method are they
Net
talking about?
assets.
Net assets. Okay. You're able to
Net assets.
you're able to know that it's net assets. That is very nice. All right. So the first one is the price earning ratio. Are you there? Okay. Papana is Limited is in advanced negotiation with the shareholders of Zanu Limited to acquire 70% shares in that company. Okay. The following financial information is provided for Zanu Limited. Number of ordinary shares, net asset per share, earnings per share, and also price earning ratio. So they have given you the price earning ratio for Zanu Limited, isn't it?
Yes.
What are they trying to tell you? They are telling you that Zanu Limited is a listed what? Company. So we are going to use their own what? Price earning ratio to calculate for the market value. We are not going to use the price earning ratio of any company. So the adjustment, we are not going to do adjustment because the company is listed. That is their value. That is their value. But let's come here. What is the number of ordinary shares that they have?
20 million.
What is the net asset per share?
8 cedis.
So what should have been the total value of the net assets?
160 million.
That would be 160. So we need to know the value of the total value of the net asset. This was the value of the net asset. This was the value after they have subtracted all the liabilities from what? Their total assets. It was 160 before they divided by the number of shares to get that. So the first thing that you have to do is that you have to find your net asset first. Find the net asset first. Okay. For you to find the net asset. Okay. Let me add another sheet so that I can solve. This is question 14. Am I correct?
Yes.
Okay. Question 14. So they say you should do price earning ratio first, isn't it? My sister,
Yes.
do the one that you can do first. You can start with the balance sheet model. Then you put your B here. Put B here. Then you do your balance sheet valuation basis. Balance sheet valuation basis. Okay. So the balance sheet valuation basis, what you have to do is that you first have to know your value of the total assets. So you say total asset before any adjustment will be made is equal to the 20 times 8. Am I correct?
Yes.
And that will give us what? 160 what?
160
160
million.
Then you now come and see, okay, before this was before they want to sell the business. So the time that they want to sell business, does any of the assets reduce? Does any of the assets increase? Are you okay? Let's come here.
Yes.
Fixed assets included in the net asset were overstated by what? 6 million. What are they saying?
It has been increased. So
Were
fair value.
overstated. Fixed assets included in the net asset were overstated by 6 million. The meaning is that if the value should be 10 million, this is the actual value. You have included 16 million.
Oh, okay.
Are you okay?
Yes.
So it means that in the value now is 16 million, but it's supposed to be 10 million. So what do we have to do?
We have to reduce.
We have to reduce. So we come to the overstatement here. Let me just make it fixed assets. Fixed assets overstated. So what we do is that we have to come and subtract. We have to come and reduce it to the actual value now. So we subtract 6 million. Am I correct? All right.
Yeah.
Okay. A customer who owes 4 million has gone bankrupt and debt considered irrecoverable. So that portion of the customer
Bad
value,
debt.
which is the current asset, are we going to take it?
Yes, you have to cancel it off.
Yes. But the 4 million has been included in our total asset, isn't it?
Yes.
So we
So
have
you
to
have to
go.
reduce it.
We have to go and take it. So you can name it bad debt, anyhow you name it, or irrecoverable debt. That is how much.
4 million.
What is the effect of this on our profits? Do we consider this
reduce
before
the-
doing the profit for the year?
No,
So what will be the effect of this on our profits?
to reduce the profit.
Okay, if you go to that place, then we do it. A provision of 10 million is made for a tax liability. Is this an asset or liability?
It's a provision, so it's a liability.
Okay, but do we consider this liability before calculating our total assets?
No,
No. What is the effect of liability on assets? Is it going to increase or reduce?
Increase.
Is liability going to increase our assets or it will reduce?
reduce.
Reduce. So we take the 10 million out. Liability is supposed to be subtracted from assets. So we take it out. So what will now be the actual value now?
140.
That will be 140, right?
Yes.
This is our actual value. This is the actual value now. But this value is the 100% of the company, isn't it?
Yes.
But what percentage are they selling?
70.
So we just find 70% of this. 70% of this particular one. So what will be the answer there?
98.
So the portion that they are going to sell, the 70 people will sell, their value will be 98. Okay. Are we okay? Okay. So that is the valuation for the first one. Let's come to the, okay, right now we can move on to our, that is the balance sheet. Anyhow, you can miss it. You can do the one that you can do first. So since we can do the balance sheet valuation first, that is why we did the balance sheet valuation. So maybe in the next one, you have now gathered the momentum to tackle the A, which is the price earning what? Ratio. All right. So we can now use the price earning ratio valuation. Price earning ratio valuation to do this. So the price earning ratio, what do we do? Market value is equal to profit after tax times what? Profit after tax times what? The price earning ratio itself. So profit after tax times the price earning ratio. We are doing it for the total. All right. Let's come and pick some of the items there. Let's see whether some of the footnotes, some of the additional information is going to affect our profits. Let me find the profit after tax first. Okay. What is our profit after tax before we are going to do the adjustments? What is the earnings per share?
15.
What is the total number of ordinary shares there?
20 million.
So how much was the earnings before one person is taking 15? Profit after tax is calculated as the profit, the earnings per share times the number of shares. So that will give us how much? 15 times
100.
20.
300.
You are getting 300, isn't it?
Yes.
All right. So this is 300. But this is the profit before any adjustments. Fixed assets included in the net asset were overstated by 6 million. Would this thing affect our profit or loss? This is not an expense. It will not affect our profit or loss. A key customer who owes the 4 million has gone bankrupt and debt considered irrecoverable. With this a loss or gain? Is it going to affect our profit?
Yes.
So what do? We subtract it from the profits. And that will give us what? 4 million. Okay. Let's come here. A provision of 10 million is made for a tax what? Liability. A provision of what? 10 million is made for what? Tax liability. Tax in actual sense, is it an expense or income?
An expense.
It can be both, depending on what the question is saying. The question now is saying that it's a liability.
Okay, it can be a tax asset.
Okay. The question is now saying that it's a liability. So since it's a liability, it means that we have not taken or we have not made provision for that particular part of the profit as tax. So this is now a tax expense. Are we okay? So we take the tax expense. Tax expense of what? 10 million. Am I correct?
Yes.
So the 10 million is now going to reduce our what? Our profits. So what will now be the adjusted profit for the year? I'm getting 286. Am I correct?
Yes.
Okay. So this is now the profit for the year. So we can now do our market value is equal to 286 times what? The price earning ratio. What is the price earning ratio there?
10.
Okay. So the market value will now be equal to 2860. Am I correct?
Yeah.
But this one, what are we doing? We are selling only what? 70%. So the market value to be placed on the 70 part will be 70, 0.7 times the 2860. The 70 that I'm doing over here is no adjustment. They have given us a price earning ratio for the company that we are valuing. So it means that the company is listed. So we don't adjust it. But the shareholders are only selling 70% of the ownership. So if they are selling the total company, it means that the market value will be the 2860. But they are selling only 70%. That is why I'm adjusting it by the 70%. So what are we getting? If I adjust that, what am I getting? 0.7.
2002.
I'm getting 200 what? 2 million. Okay. So I'm done with that one too. The next one that I will do is what? The cash flow valuation what? Model. So that I will do cash flow valuation model. Cash flow valuation model. So the cash flow valuation model, I'll have the years, then I'll have the cash flows. Let me put it in full cash flow. Then I will come to my discount factor. Then I will come to my present value. Okay. So the finance manager provided a statement showing projected cash flow for the next 5 years as follows. So we use the cash flows for the subsequent year. So if the question gives you a cash flow for today, we don't use it because that has already been taken. We use cash flows for the future period. So the year one, what is the cash flow that they are talking about? 125 what?
Million.
So let's come here. Papana limited cost of capital is what? 16%, isn't it?
Yeah.
And a risk premium of 4% is added in the valuation of Zanu Limited to take care of additional operation what? Risk. Okay, they are saying that your required rate of return is 16, but you are going to incur additional 4% risk as a result of the company that you are operating in. So what will be your total cost of capital now?
20%.
20%. So if you have any risks, you add a risk to it, to the current cost of capital, to have the actual cost of capital, which is 20%. So year one, what is the discount factor at 20% in year one? That would be 1 divided by 1.1, 1.2. What are you getting? I'm getting 0.833. Okay. Let's come to year two. This one, you can see the cash flows are not the same. If not, we should have used annuity. But since they are not the same, we use the discount factor for each year. The years are 5. So let's come here. Let's take the cash flows one by one. 150, 200. What else? 110. Okay. Let's count to the discount factor for 20% in 2 years. That will give us 1 divided by 1.2
0.694.
0.694. 0.694. Okay, year 3 will give us what?
0.578 or 57.
0.578. Okay. Year 4.
0.482.
0.482.
82.
Okay. 0. I'm coming in.
Okay.
Okay. 0.4. 0.482. Year 5 is what?
0.401 or 402. Any of them.
Okay. 0.402. Yes. To 2 decimal places. 0.402. So what do we do now? For us to get the present value, we multiply the discount factor by the cash flow. Am I correct?
Yes.
Okay. So this is what I'm going to get. Let me track it down. So what will I do? For me to know the total present value, then I'll add the present value one by one, isn't it?
Yes.
Okay. So I'll do this. I'll add them one by one. So I have this. Then this is the value now. This is the total value. But what portion are we selling?
70.
So portion, the portion will be 70%. So what do? We find 70% of this.
Yes.
Okay. So that is what they're asking us to do. The next question is what? I'm sure this is December or August or something. Explain 3 reasons business valuation is taking in the corporate environment. They are just telling you the reason for business valuation. When the shareholders want to sell the business, when the business want to go public, when the business is in liquidation position, when the business,
And there is a measure.
when there is a merger or takeover. So those are the things that they're asking you to write there. Let's try and see whether we can solve additional one question. Then
Okay.
okay, let's look at this value. Let's look at question 16. I hope if you are now giving question on business valuation using net asset method, using price earning ratio, using market, using dividend yield, you can do something. Okay. Even if you are giving any yield is the same as the dividend yield, but the earnings yield, we use earnings per share. All right. Let me solve this one where you will be asked to calculate the cost of redeemable debt. Let me calculate that. Okay, I don't have the last sitting the question. I wasn't able to type it. But what will happen is that next week we are doing working capital management. But before we start with the working capital management, I will solve last sitting business valuation question. Then I will try to see maybe I can solve additional. What is the total number of questions we have? It's 16, isn't it? A16. Can we try to solve additional 2 questions before we close? Do you have people
Yeah,
here?
so yeah.
Should we solve
Yes.
additional 2?
Yes.
Mm,
Okay. 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 So let me see whether we can. Okay. Let's try the let me see whether which one we can solve. Okay. Let's all the things that we have solved was net assets method, price earning ratio, and dividend yield. Those are the 2 that we have used, isn't it? Let's use dividend growth model and earnings yield. Let's look at the question 12. Who is reading? Who is reading question 12?
Chart Company is a stock market listed company which has managed to increase earnings over the last year. As a result, the board of directors has increased the dividend payout ratio from 40% for the year to March 2014 to 41.4% for the year to March 2015. Chart Company has a cost of equity of 12.5%. The following information is also available. So we have year to March 2014-2015 with 3 zeros on top. We have earnings 13,200 for year 14, 13,840 for year 15. Ordinary shares, we have 8,000 for year 14 and then 8,000 for year 15. The nominal value of the ordinary shares of Chart Company is $0.50 per share. Listed companies similar to chart company have an earnings yield of 8.2%. Required. A. Calculate the equity market value of chart company using a dividend growth model. B. Calculate the equity market value of chart company using the earnings yield method. C. Discuss the relative merits of the dividend growth model and the earnings yield method as a way of valuing chart company. Hello?
Yeah, I can hear you.
Yes, I'm done.
Okay. All right. So they say that Chatco is a stock listed company which has managed to increase earnings over the years. As a result of the board of directors has increased the dividend payout ratio from 40% for the year to, okay, so the 2014 was 40%. 2015 is now 41.4% for the year to what? March 2015. For the year to March 2015. All right. What is the dividend growth there? What is the dividend growth rate?
1.4.
No. I know someone will say 1.4. Okay. I'll show you how you can calculate the dividend growth. All right. If they say the dividend payout ratio, it means that 40% of the earnings is paid as dividends in the first year. Are you okay? Calculate that, let's see something. So in the 2014, how much was paid as dividends? It will be 40% of the earnings. Dividend paid in 2014
5280.
will be 40% of the earnings, which is 0.4 times the earnings. The earnings is what?
13 to 1.
13,200. So if they say dividend payout ratio, it means that that is a portion of the dividends. That is a portion of the earnings that is paid as a dividend. That is what we call a dividend payout ratio. So they are paying 40% of the earnings as dividends and maintaining 60% at retained earnings. So what is the dividends we are going to get there?
5280.
5280. Let's count to, this is 2014. Let's count to 2015. Okay. 2015, the dividend that will be paid will be 41 point what?
Oh.
Okay. So that will give us 0.414 times the earnings for 2015. What is the earnings? 13,840.
840.
Okay. What will be the dividend paid?
5730.
57.
30. 30.
Are you approximating it?
Yes.
Okay. 5730. Okay. Let's look at what is the movement in the dividends. The dividend has increased by how much?
Okay.
The dividends has increased by how much?
Then
So
92%.
growth is calculated as, or increase is calculated as the current value minus the previous value divided by the current value, the previous value, times 100. That's how we calculate growth or increase in something. So the growth will be calculated as what? Dividend growth will be calculated as 450 divided by the initial one, 5280. What is the answer?
Is that 0.085? 0.085.
Okay, multiply by 100.
8.5.
Okay. So the growth is equal to 8.5. Growth is 8.5%. Okay. So for you to calculate the growth, what you do is just find the dividend for each of the years, find them. Then you compare what is the increase. So it means that the initial dividend has grown by 8.5. That is the growth. Don't go and be taking the difference over here. The difference is not the growth. The difference are not the growth. The difference are not the growth. Even that difference, right, if you want to do it, it will be the 1.4 divided by the 40% times 100. You are getting 3.5. This 3.5, this 40 and this one, they are on different figures. They are not on the same figure. The 40.14 is not on the initial dividends. It is on the earnings now. It's not on the initial earnings. It is on the current earnings now. That is why we have gotten the dividend payout ratio like that. So the easiest way to do is find the dividend for each of the year. Then you look at the increase. You calculate the growth in the dividends payment or something like that. All right. So can we move on now? Okay.
Yes.
Okay. Don't say that I've given you a formula which is dividend growth is calculated at the nth root of current dividend over initial dividend. That is if the dividend is being paid maybe for number of years. If the years are 5, then we calculate a constant growth. But this one, the dividends are only 2. So know that they are more than 2 that we say, okay, we are looking for a constant growth. So that particular formula is used to calculate a constant growth. But this one, the dividends are only 2. Look for the dividend figures for each of the years. Find the increase. The increase is the growth. Okay. The question says that we should use dividend valuation what? Using dividend growth what? Model. If you're using a dividend growth model, we are going to use cost of equity is equal to DO is 0 into brackets
0.8.
into bracket 1 plus 8. 1 plus G. Let's do it
0.
first before we move on. We do it like that. All divided by the PO, isn't it?
Yeah.
Then all of these answer plus what? G, the growth. Okay. The growth. So what we do is that, okay, since we are looking for the price earning ratio, it will be P0 is equal to DO into brackets 1 plus G all divided by KE minus what? G. In the exam, you can put all of these things in this before you make the PO the subject. Before you make the PO the subject. So let's come now. what will be our dividend that will be paid? What is our dividend for the year now? What is our current dividend? It's 5730. Am I correct?
Yes, 570.
Okay. The question didn't say calculate your market value per share. If the question say calculate your market value per share, then we now find dividend per share. So we divide the 57 by the number of ordinary shares that they have there. Okay. But the question just say calculate the equity value of Chartco using the dividend rate model. So we can use the total dividends. So 5730 divided by what is the cost of capital for the company? At the top, what is the cost of capital for the company?
12.5.
So 0.125. Am I correct? Okay.
Yeah.
This one I will do. This will be
The
multiplied by
increase.
1.085. Am I correct?
Yeah.
Okay. Then all of this will now be minus what?
Minus 0.85.
0.085. Am I correct?
Yes.
So our PO now is equal to the top 1.085 times 5730. I'm having 6217.05. 6217.05. All divided by what? 0.125 minus 0.085. I'm getting 0.04. Okay. If you divide, what are we getting? Okay. I'm getting 155426.25. Okay. That is the value. That is the first one. Let's come to the second one, which is what? They are saying we should use price earning what? We should use the earnings yield. Okay. Earnings yield. So using the earnings yield. How is earnings yield calculated? Earnings yield is what? Earnings per share over
Earnings
what?
per share over market price.
Over the market price. So market price will now be equal to earnings per share over what? Earnings yield.
Earnings yield, yeah.
Okay. Am I correct?
Yes.
Okay. The question didn't say we should calculate the market value per share. So instead of the earnings yield, we can use the total earnings. Instead of earnings yield, we can use the total earnings. So market value will be equal to total earnings for 2015 is what?
13,840.
Okay. We normally do the valuation for the current year, not the previous year. Okay. 13,840. All right. The nominal value of ordinary shares per share listed companies similar to, okay, listed companies similar to Chartco have an earnings yield of what? 8 point what? 8. The Chartco, is it a listed company?
Yes.
Yes.
Okay, it's a listed company. So if a listed company, that means we use the total earnings yield for them. But if it is not a listed company, then we adjust the earnings yield by 20%. Okay, so we have 0.082. What are you getting? What are you getting? I'm getting 168,780.
780.
Okay. Sometimes they can ask you to advise what value the company should place on their shares. They can ask you to advise what value the company should place on their shares. You tell them to take the highest one. Are you okay? You tell them to take the highest one. So the methods that give you the highest value, you advise the company to use the highest one. Okay. That is any yield. Any yield, sometimes you are going to adjust the profit too, because there will be some items that will make the adjustment to be made to the profit, because we are using earnings per share. So we are going to adjust the profit. But this particular question, there is no other thing that is telling us whether our profit has been overstated or anything. That's why we use the earnings for the 2015 as the actual earnings. There can be some time that you do adjustment to the earnings before you get the adjusted earnings, before you do your valuation. Okay, discuss the relative merit of the dividend growth and then the earnings yield as a way of valuing Chartco. They are in the notes. You have time, read them. Those are the advantages. Let's look at the last question. Okay. The last question, 16. Question 16. Okay, before I move on, what we are going to do is that after we finish with the topic, we pick one day to come and go through maybe the tutorial question, maybe at least 5 of them. I will not solve them, but I will explain them to you how you solve. But the ones that I can maybe, because we are going to use one day, we can't use one day to solve most of the questions like that. Are you okay? So
Yes.
I will just explain some of them to you. Most of the tutorial questions, I will explain them how you go about it. The ones that you are not getting it like that, then I will try to demonstrate how you should solve it and those things. We just come and do explanation, do overview of all of them before
Okay.
you go and write the exam. So next week we are doing working capital management. We are finishing that day. Then we now have time for investment appraisal. Investment appraisal, we use like 2 meetings. Then we finish it. Then we now come to financial risk management. If all things being equal, after the working capital management, I can do financial risk management before the investment appraisal, because the investment appraisal is too much. It's too loaded. All right. Let's look at the question 16, the last one, then we move on. Joycelyn, we are waiting for you to read.
Then question 16.
Yes.
Food Limited has an issue 12% bonds with par value $150,000 and redemption value $165,000 with interest payable quarterly. The cost of debt on the bonds are 8% annually and 2% quarterly. The bonds are redeemable on 30th June 2021, and it's now 31st December 2017.
So,
Required, calculate the market value of the bonds.
okay. So how many years would the bond be redeemed? How many years time?
6 years or
Are you sure?
30th June
2017.
30th June 2021. But now it is now 31st December 2017. So now we assume that it's 2018 already.
5 years.
3.5 years.
3.5 what?
Yes.
Okay. 3.5 years. Okay. So right now they have given you this one. You can solve the questions in 2 ways. You can assume that the interests are paid quarterly or annually. Any of them will give you the answer. Are you okay? All right. So we do all the two. Okay. They have given you the cost of capital already. So your discount factor will be the cost of capital. So you are not going to do any guessing to get negative or not. We only do that to get the cost of capital for the debt. But since you are giving the cost of capital, we now use that cost of capital to present value the interest payment and then the redemption. Are we okay? All right.
Okay.
So what we do is that the cost of this one, we have the years, we have the cash flow, then we have the discount factor, then we have what? The present value. The first one we are going to do it quarterly, and you compare the answer with the yearly and see. They all give you approximately the same answer. Okay. So it is now 2018. 2018 is 1 year, 2019 is 1 year, 2020 is 1 year, 2021 is half a year. So that is 3.5 years. So you are going to receive the interest for what? 1 to 3.5 years, isn't it?
Yes.
Okay. 1 to 3.5 years. But this one we are doing it quarterly. So 1 quarter, 1 year, how many quarters are there?
4.
2 years, how many quarters?
8,
3 years is how many quarters?
12,
And you are going to do 6 months in addition. So how many quarters in all?
20.
No. 3 years is 12. Though the 6 months is 2, that will give us 14.
14.
The quarters in 3 years is 12. 6 months, how many quarters are in 6 months? It's not 2.
Yes.
Yes.
Okay, 2
And 1
plus 2.
quarter is 4.
Yes. One
So
one
when
year
added
is
to the
1 year is 4 quarters.
yes,
So 3 years
and
is
then
12.
6 months will be 2, so 8
Yeah.
quarters.
That will be 14. The interest will be paid for 3.5 years. We are
And
redeeming
14.
the debts in 3.5 years time. So the interest will be received for 3.5 years. But we are paying the interest quarterly. It means that in the year 1, they will receive the interest how many times? 4. Year 2 is also 4. That is 8 times. Year 3 is also 4. That is what? 12 times.
Sure.
But they will still receive additional 6 months. 6 months is giving us 2 quarters.
Okay.
Joyce, your network is bad. Joyce, your network is bad. So if you can talk, if you can say what you are saying again.
So I'm saying that she said
Just like I can hear you.
please, can you hear me now?
Yeah, I can hear you.
I'm saying that there are 4 quarters in a year,
Okay.
and then there's 6 months. And it means if you are dividing, then the 6 months should be 2 quarters, right?
Okay.
Yes.
So that will give you 14 quarters.
So
Do you agree with the 14 quarters in all?
no,
Okay. In how many years time would the debt be redeemed?
3.5.
Okay. How many quarters will be for 3 years?
12.
The 6 months, that is the half year. How many quarters are there?
2. Oh,
So if you add the 2 to the 12, which is the 3 years, what are you going to get?
14.
14. So 3.5 years will give us 14 quarters in all. Another way of doing this is that just multiply the 3.5 by 4. What are you getting?
Okay.
So what will be the interest payment every quarter? The interest will be paid on the par value, isn't it?
Yes.
So they
Yeah.
have given us 150. Don't use the 100 because they are giving us total values now. So we use total values. But the interest is 12% every year, isn't it?
Yes.
Yeah.
So a quarter will be how much?
3%.
So 3% on what? The 150. How much interest are they receiving every year? How much interest are they receiving every quarter rather?
450.
I'm getting 4,500. Am I correct?
Yeah.
Okay. This is now equal payment for every quarter. So this is now annuity, isn't it?
Yeah.
So we now use annuity factor for this. What will be the annuity factor? It will be 1 minus into brackets 1 plus the quarterly interest rate is what?
3.
3. So it will be 1 plus 0.03 exponent the number of quarters that the interest will be received. That will now be what? Negative what?
14.
Negative what?
14.
14. That is nice. Divided by 0.03. What are you getting as the annuity factor? I'm getting 11.296. What is someone getting? Okay. Jocelyn, what are you getting? So in the 14th quarter, what will happen? They will redeem.
Sir,
What?
go over can you go over the discount factor again?
The discount factor is, since the 4,400 is even, is every quarter 4,400. So it means that this is now annuity. So you use the annuity factor, which is 1 minus into bracket 1 plus R, or exponent negative n, divided by the R, or divided by the R. So in this case, the R now is the quarterly rate, which is 3%. And our N now is the number of quarters that the interest will be received, which is now 14.
Okay.
Are you okay?
Yes.
Let's come to in the 14th year, what will happen? They will redeem the what? The debt, isn't it?
Yes.
What is the value? Would this be redeemed at par, or it will be redeemed at a different value?
At par.
No.
Oh.
Food Limited has in issue 12% bonds with a par value of 150 and redemption value of what?
Okay, sorry. 165.
So it will be redeemed at the 165. But if the question didn't say anything about the redemption value, then we assume that it will redeem at what? Par. Are you okay?
Okay.
This is a one-time payment. So what we do is that we use the discount factor for 14. We assume that the years is 14. So we find the present value in the 14th quarter for 165. So in this case, we use the discount factor, not the annuity factor. So you have 1 divided by 1. What will be the discount rate? What rate are we using?
12%.
We are using 3%. That is quarterly. We are doing this quarterly. So it will be 1 divided by 1.03, or exponent what?
1.
Or exponent what?
1.
No.
4.
14. This will be done in the 14th quarter. So since we are doing the quarter, the number of quarters now becomes the n. If you are doing monthly, then the number of the n now becomes the monthly, the number of months that you are going to do this. But this one we are doing quarterly. So it means that the n now is quarters, not years again. So we do in the 14th quarter. What will be the discount factor? I'm getting 0.661. Is someone also getting the same thing? Joycelyn, are you there?
I'm there.
Okay. So what will be the total now? The total now is 15 days. And this is the market value of the company. This is the market value of the debt. Because if we know the market value, we'll have subtracted the present value of the interest and those things from it to get 0. If they say cost of debt, we are talking about the interest or the percentage rate that will give us the debt values to be 0. Looking at the market value and then the present value of any amount that they are going to receive, they will be 0. So if they say the 3% now, sorry, no, we use the cost. We are going to use the discount rate should be the cost of the debt, which will be 3%, which will be 2% rather. Sorry. It's supposed to be 2%. Then the discount factor that we use is the cost of the debt. So the cost of the debt are 8% annually and 2% quarterly. So the discount rate is supposed to be 2%. So it means that the annuity factor is wrong and this one is also wrong. Let's do the annuity factor right now. It will be 1 minus into brackets 1.02 or exponent negative 14 divided by 0.02. I'm having 12.106. Okay. Then this will be 1 divided by 1.02 exponent 14. I'm having 0.758. Okay. So for the discount factor, we use the cost of debt, not the guessing. The cost of debt. They have given us the cost of capital already, so we use the cost of capital. But for the interest calculation, we still use the nominal rate. That is why we use the 3%. Right.
Okay.
This is on quarterly basis. Let's count to annually. Let me show you. You are going to get approximately the same answer annually. Annually, it will be 1 to how many years? 3.5. Am I correct? The interest will be received from, because the bonds will be redeemed in 3.5 years, they are going to receive the interest continuously for what? 3.5 years. Are we okay?
Okay.
All right. So what will be the annually interest rate? It will be the 12% on the 150. And that will give us 18,000. Okay. The discount factor will now be what? The cost of debt, which is annually, which is be what? 8%. Am I correct?
Yes.
Okay. So this will now be 8%. So let's find the annuity factor for 8% for 3.5 years. It will now be 1 minus into brackets 1.08. What will be the exponent now?
40. 3.5.
3.5. It will be 3.5. Don't say you don't know how to do 3. Just put 3.5 there. Exponent 3.5. All divided by 0.08. I'm getting 2.952. So I will just multiply this by this. Okay. Then in the 3.5 years, what will happen? They'll redeem it, isn't it?
Yes.
At 165,000. So what will be the discount factor in 3.5 years? It will now be 1 divided by 1.08 exponent 3.5. I'm getting 0.764. So I'll multiply. So at the end of the day, I'll add a 2. So this plus this. What are we having? You can see that they are approximately the same thing, isn't it? It's because of the approximation that we did. Because you can see that they are all 179. So it's the approximation that is making the difference. So you can use the quarterly or you can use the annually. So this is now the present value of the debt. So if it is irredeemable, we use the interest payment the way we do it. But this one, the discount rate is not a guessing one now. They have already given us the cost of capital, the cost of the debt. So we use the interest or the cost of debt rate as the discount rate. So if you discount the total of all the figure that you have gotten is the current market value of the irredeemable debt. All right. Do you have any question? So we have solved 4 questions. That is very nice. So you try to go through some of them. And after everything, we take time to go through some of the tutorial questions. I know there are plenty, so we try to explain at least 5 of them. At least we try to explain 5 of them.
So the discount factor for the 2%.
Yes.
Were we using the ordinary annuity?
Yes, we are using ordinary annuity. We assume that it is at the end.
So is there 1 minus 1 plus R
Yeah.
raised by negative. So it will be negative 14.
Yes, negative 14. All divided by 0.02.
Okay.
Okay, so if you are doing it quarterly or semi-annually, the question now is the exponent is now in terms of semi-annually because you are using semi-annually rates. The exponent is determined by the rate that you are using. If the rate is annually rate, then the exponent will be in annual, will be in years. If the rate is monthly rate, then the exponent will be in monthly. Are you okay?
Yes.
All right. So the exponent is determined by the rate that you are using. All right. So
And then the second one, the 0.758.
the second one, which
That
is
one
the
to do
8%.
no. After the 12 points, we are still on the 2%. The
Okay.
second one, that's when we redeemed all.
Yes,
The
then it will be 1
0.75.
divided by 1.001 1.02 or exponent 14 because the redemption will be down in the 14th quarter. So the exponent is now 14 because we are using the quarterly rate. Just like
So that one to what annuity are we using? Or
it's no
is it
annuity. This is one-time payment. So we use only the discount factor, which is the 1 over 1 plus R exponent n.
okay?
All right. It's a one-time payment. So we use only the compound interest discount factor, not the annuity. Annuity is where you are receiving equal amounts at the end of every year or at the end of every quarter, at the end of every month or at the end of every 6 months. That is where we use the annuity. But if you are receiving the money at once, that is one money that you are receiving in future time, then this is now a compound interest, not annuity. So we use the 1 over 1 plus R exponent n. All right. Okay. I hope we are done now. We have solved 4 questions. And that is okay for now. Next week, we are doing working capital management. That is also another. Business valuation is 20 marks. If you don't know, I'm telling you, question 2, 20 marks. You can't go to FM examination hall that you not see question on business valuation for 20 marks. Question 2 is there. Working capital management is question 5, which might be for 20 marks or sometimes 15 marks. So take that seriously. Long-term decision making, which is investment appraisal, is 15 marks. Question 4, 15 marks A. So all that we are coming to do right now are all coming in the exam. Business valuation is coming, working capital management is coming, investment appraisal is coming, and financial risk management is coming for 10 marks. Mostly is the theory questions. So the 4 topics or the remaining 3 topics that are left now are examinable topics. If you go there, you don't see them, then ask the invigilator that this is not FM paper. Because you have to see investment appraisal, you have to see working capital management, you have to see business valuation, and you have to see financial risk management. All right. Ladies and gentlemen, if there's no further question, I'll see people same time next week. It will be 7 a.m. Good morning. I'll see you all next time. I sign out.
Thank you very much.